three different types of financial markets: the money market, the credit market, and the capital market. On all three markets, trading takes place in the commodity of money, as well as in liquid assets and derivatives. The size of these markets is quite enormous. According to an IMF estimate, in 2011, the size of the capital market alone was around 145 trillion US dollar. By comparison, global GDP in 2011 only amounted to 70 trillion US dollars. About 2/3 of the capital market's total volume are bonds issued by states and corporates. And the other third is the market capitalization of listed companies. This is the total value of their shares. Let's first start with money markets. Money markets are short-term markets. Usually, money is lent on these markets to bridge short-term liquidity gaps, for example, to pay wages before revenues for already sold goods are received. Banks also lend each other excess liquidity overnight or for a very short period of time on the money market. However, this interbank market temporarily came to a complete halt as a consequence of the financial crisis of 2008-2009. On top of this, there are foreign exchange markets where currencies are traded. The prices on foreign exchange markets are referred to as exchange rates. They express the price of one currency in another currency. The second market we look at are credit markets. The credit market is dominated by large and small retail banks. They bundle savings deposits or borrow money from central banks and lend it in turn in the form of loans to private households and to companies. Securitization, for example in the form of asset-backed securities like mortgage bonds, makes it possible for the banks to sell their future claims against debtors to financial investors. In continental Europe, but also in China and Japan, the credit market operated by commercial banks is the most important source of financing for the real economy. This brings us, thirdly, to capital markets. Because the other form of financing of the real economy takes place through the issuance of shares and bonds. Companies raise core capital by offering shares that give investors direct ownership in the respective companies. And companies issue bonds through which they borrow money from investors. The owner of a bond is therefore a creditor, while a shareholder is a co-owner. And this can make a big difference in the case of insolvency. States also raise funds through capital markets. When tax receipts are insufficient, states usually issue sovereign bonds and treasuries in order to be able to meet their financial commitments. The raising of capital takes place on the so-called primary markets. Active on these markets are usually only selected participants, such as banks, insurance companies, and large investment funds. This strictly limited circle of buyers makes bids for the newly issued bonds or shares. These are then auctioned off or allocated accordingly. If possible, shares and bonds are later on sold to other investors on the so-called secondary market. Normally, shares and bonds of medium-sized and larger companies and sovereign states, after their issuance, are traded on the stock markets. Supply and demand on these stock markets determine the price. This enables investors to constantly check the value of their stocks and bonds and possibly sell them and reinvest their money. Apart from stock exchanges, there are also grey capital markets. On this market, transactions predominate in which buyers and sellers of securities or derivatives directly enter into a transaction with each other. These trades are referred to as over-the-counter trades. In contrast to the stock exchange, these markets are unregulated and completely lack transparency for outsiders.